You put your money in the bank because it's safe. That's what everyone tells you. That's what you believed your entire life. But here's the question nobody ever asks. Where exactly does your money go the moment you deposit it? Because here's the uncomfortable truth. The second your paycheck hits your bank account, the bank does something with it. Something most people never find out about. And by the time this video is over, you may never look at your bank account the same way again. Let's start with what the bank tells you. You deposit $1,000. The bank keeps it safe. You earn a little interest, maybe 1% a year, maybe less. The bank is just holding your money like a giant locker. Right? Wrong. Completely wrong. What actually happens is one of the most profitable systems ever invented. And it was designed so that you would never think too hard about it. The moment you deposit your money, the bank lends it out. Not some of it, almost all of it, to someone else, right now. While your balance still shows $1,000 on your screen, this is called fractional reserve banking, and it is the foundation of the entire modern financial system. Here is how it works. When you deposit $1,000, the bank is legally required to keep only a small fraction in reserve. In the United States, that reserve requirement was actually reduced to 0% in 2020. Zero. That means banks can theoretically lend out every single dollar you deposit. But it gets stranger, because the money the bank lends out doesn't disappear. The person who borrows your money deposits it into their own bank account, and that bank lends it out again, and again, and again. $1,000 of real money can become $5,000, $10,000, even $20,000 circulating through the system. This is called the money multiplier effect, and your original deposit is sitting at the center of it. So right now, while you sleep, your money is working. Just not for you. Here's where it gets personal. The bank takes your deposit, lends it to a mortgage borrower at 6% interest, a car loan customer at 7% interest, a credit card holder at 20% interest. And what does the bank give you in return for using your money to generate all of this profit? The national average savings account interest rate in the United States is currently around 0.45%, less than half of 1%. Think about that mathematically. The bank borrows your money for 0.45%, lends it out at anywhere between 6 and 20%, and keeps the difference every single day on every single account across millions of customers. JP Morgan Chase made $50 billion in net interest income in a single recent year. Bank of America made $57 billion. Wells Fargo made $45 billion. That money came from somewhere, and a very large portion of it came from the gap between what they pay depositors like you and what they charge borrowers. You are not the bank's customer in the way you think you are. You are the product. Your deposits are the raw material, and the bank is the factory. But here's the part that sounds like science fiction. The bank doesn't just lend out your money. It actually creates new money when it makes a loan. When the bank approves a $100,000 mortgage, it doesn't go into a vault and pull out $100,000 in cash. It simply types the number into a computer. New money, created from nothing, backed by your trust in the system. The Bank of England officially confirmed this in a paper published in 2014. Commercial banks create money whenever they make loans. Not the government, not the central bank, your local bank branch. Every time someone takes out a loan, new money enters existence. This means the entire money supply is largely made up of bank-created debt. And it means the bank is profiting not just from your deposits, but from money it invented. So what can you actually do about this? Because knowing the system is only useful if it changes something. First, understand that a standard savings account is one of the worst places to store money long-term. Inflation in the United States has averaged around 3% per year historically. If your savings account pays 0.45%, you are losing purchasing power every single year. Your balance goes up, your wealth goes down. Second, high-yield savings accounts at online banks currently offer between 4 and 5% interest in the current rate environment. That is 10 times what traditional banks offer. The money is still FDIC insured up to $250,000. There is no good reason to leave money in a big bank savings account earning almost nothing. Third, the wealthy do not keep their money in savings accounts. They keep it in assets, index funds, real estate, treasury bonds, things that grow at a rate that actually beats inflation. The bank wants your money sitting still, because still money is money they can lend at a profit. The system is not illegal. It is not a conspiracy. It is simply how modern banking works. And it was built at a time when most people had no idea it existed. That information gap is what made it so profitable for so long. But now you know. Your money is never just sitting there. From the moment you deposit it, it is working inside a machine built to generate returns for shareholders, not savers. The only question that remains is whether you are going to keep letting it work for everyone else or start making it work for you. The bank was never keeping your money safe. It was borrowing it. And the interest you earned was never a reward. It was a distraction.